Well, as we continue to cover the tragedy in Southern California, another crisis is underway, an insurance crisis, and it's one of California's own making. In 1988, California voters passed Proposition 103, a textbook example of the left-wing love affair with government price controls and heavy regulation. Under Prop 103, insurance companies have to get government approval before raising rates. The red tape hasn't allowed insurance prices to keep up with insurance losses. And over time, that imbalance causes the entire system to collapse. As you can see here, major players like State Farm and Allstate have pulled back on writing insurance, leaving thousands of homeowners scrambling for alternatives. That's where California's state-run insurer of last resort, the FAIR Plan, comes in. But here's the problem. The FAIR Plan is woefully underfunded. It has about $700 million in reserves, but the Pacific Palisades fire alone represents a $6 billion liability. The math just isn't adding up. And California homeowners and taxpayers, as a result, may be on the hook. Well, joining us now is Kaya Stanley, CRMBC CEO and insurance industry expert. Kaya, we're glad to have you with us today. Help us understand what's happening with insurance in California and why it's really important for other states to pay attention to what's happening here.
It's important because it's going to ripple outside of California and affect every state. So as you pointed out, one of the reasons, there's many reasons why the insurers pulled out, but one of them was because of regulatory requirements. Reinsurance went up, inflation, caused increases in pricing. There was a lot of factors. And then when insurance companies can't be profitable and they can't raise their rates because of regulatory requirements, they are going to leave. And so that's what we saw here. And they only left the high risk areas. So a lot of these companies still write insurance in other parts of California and other lines of insurance. So they might have just pulled out of homes, but in businesses, but they still write auto, for example.
There's a great article in the Wall Street Journal that says when California's insurance falls short, everyone else pays. You hinted at this, right? That we could actually see rates for insurance in other states go up because of some of the policy issues that we've seen in California. Does that data and that analysis track with what you see and what you hear?
Absolutely, because the point of insurance is to spread risk. So we collect rates from the many to cover the few, the losses of the few. And when you have a natural disaster, and not just in California, but the other natural disasters that we've seen around the country, that disrupts that balance. And so the money that's collected to cover the losses of a few is just decimated. And so they've got to recoup their money somewhere. So they're going to look to states that have no natural disasters and less risk and less regulation. And then people in like Maine and Vermont who didn't do anything wrong and had no natural disaster, they're going to see their rates go up because this has got to balance out somewhere.
Yeah. Everybody agrees that this is the worst natural disaster in U.S. history, even Gavin Newsom. President Trump is asking some logical questions about what went wrong here in California specifically, and he's making a comparison to other countries. Please listen.
You go to other countries in Europe, Austria and Finland and numerous countries, and I talk to the heads, they're forest nations, they're in forests, and they don't have problems like this.
The head of Austria tells me, we have trees that are much more flammable than what you have in California. We never have forest fires because they maintain their forests. And you could revert water up into the hills where you have all the dead forests, where the forests are so brittle.
As we talk about insurance here, if we don't address the why this happened and correct it, we're only going to find ourselves in this particular position again. Why aren't we looking to other countries as a model?
The solution to this is going to be very complex, and it's going to take decades to build out of this. Looking to other countries is one of the things that should happen. The other problem is when you've got different states that are doing different things. So, for example, what California is doing, it's now going to impact negatively other states as well. So there has to be some way that we can bridge that across the entire country. So they're going to be looking at all kinds of solutions, from incentivizing solutions to maybe tax credits to also regulatory changes that need to happen, because for-profit companies have a right to make a profit. They can't be required to stay in an area where they're not making money. I represent restaurant owners. So if food prices doubled it wouldn't be fair for us to say,
Yeah.
and they have to now pay more minimum wage. We can't now say, okay, you can't increase the prices of your menu.
Yeah.
And that's sort of what we would be saying to insurance companies if we said you can't raise your rates. But the alternate is also impossible. So if they raise their rates so much that people can't afford insurance, that's also a horrible result that
Right.
would happen. So there has to be some public-private solution to this. It's not going to happen on just one side or the other.
Well, I'll tell you what, the market solves a lot of those problems well, but when the government's so involved in the market, it can't clear prices. Kaya, we got to leave it there, but that's a really good analysis. Thanks for being with us today.